Okay, guys, I'd like to talk to you today about the Licensing and Standards Committee, Toronto, City of Toronto, rather, April 10th, 2018. And some other cities are going to go through similar processes in regards to the payday loans industry. Now, for full disclosure, I've been in the payday loan industry for a little over 20 years. I'm very proud of it. Suffice to say, it's been my life's work. I started out as an employee of one of the big microfinancial solutions providers, and basically moved my way up into management. Worked at another establishment in a high-level management position, and eventually now have started my own firm. And I just wanted to get that out of the way to give you guys full disclosure. But later on in this video, at the bottom there, I'm going to share some links, basically our stats and facts. And I'd ask that when you watch this video, you keep an open mind and almost put yourself in the position of the debutants of this industry, and understand that bullying people and bullying businesses because of a incorrect narrative or political agenda is not the correct way to do things. I like to think that politicians and councillors in our city are taking in all the facts and trying to make decisions based on fact and coming up with decisions that are best for the community. As you'll see in some of the links that I've shared, basically there are reports and committees that were put together that find favorably for payday loans, and then there are other ones that do not, and I've included both. But one thing that you can't argue with in any of those reports is the numbers. For the most part, the numbers are the facts that we need to rely on in order to formulate an educated decision or response in regards to this industry. I think you'll find that looking at some of those reports, you're going to realize that a payday loan is not as expensive as some of its alternatives. Those alternatives include, NSF fees, overdraft fees, even credit card fees, and lines of credit. Unfortunately, because of the way people play with words and try to attach things like APR and other things, you really have to go to these economists and these reports that are out and really dig into the meat and potatoes of the reports to understand really what you're looking at. And in some of those reports, you're going to find that what I'm talking about is proven using mathematical equations as opposed to rhetoric and my sheer opinion. Shortly I'm going to start this video, and throughout the video I'm going to pause and talk to you about some of the comments that are made by some of the counselors, and basically point out some very disturbing issues that I have with this particular License and Standards Committee. Not everybody there was as troubling, and some of the counselors, or at least one of them, that, in my opinion, was trying to be objective and trying to look at the facts and look at everything, as opposed to jumping on the bandwagon of the common narrative out there. And by the way, this narrative is brought forth, and I'm going to get into that later, who I believe is responsible for the narrative. Of course, it's just a theory. And I have no real facts except for the evidence of the numbers. It would indicate that someone much more powerful than the people are pushing for these standards. So without further ado, I'm going to get into this video and let you soak it up. And like I said, I'm going to pause along the way. Again, my name is Wes Barker, and for clarity and transparency, I am on the opposite side of this policy and don't believe that these policy changes are needed or are beneficial to the people of Toronto. But nonetheless, I think it's important that you hear both sides of the story. But more important than hearing both sides or both opinions, I think it's important to consider the facts and the mathematical facts of the effect of over licensing particular products and services that the community needs. So without further ado, I'm going to start the video, and like I said, I will pause it from time to time.
Tony Irwin, Patrick Mohan, and Donna Borden. I'm just members of the public, and please let's stick to the report, to the recommendations of the report, and otherwise we're going to. It's not fair to all these people that have been waiting for all day for the next item. So please go ahead, 3 minutes.
Oh, do I have to turn this on, or
You
is it
have
on
the
now?
red button there, yeah.
Sorry, apologies. My name is Tony Irwin, and I'm with the Canadian Consumer Finance Association. We represent financial service businesses that provide payday loans, as well as a range of other financial services, including check cashing, installment loans, wire services, bill payments, and foreign exchange. Our member companies hold lender licenses for approximately 871 stores and online lending platforms across Canada. CCFA members provide much-needed safe, licensed, regulated credit to hardworking Canadians when no one else will. Last year, some 2 million Canadians took out a payday loan at an average size of $500 for a term of 10 days, and on average, they take it out 6 times a year. Payday loans are used by a wide range of Canadians from all walks of life: nurses, firefighters, office workers, members of your staff, who all are employed and have bank accounts. They're good people in a bad spot. Borrowers know the cost of credit is high. However, many people use this service who are facing an emergency and have no other options. A single mother holding down 2 jobs who has a shortfall in income this month and needs to pay rent or buy groceries for her kids. Or a senior on fixed income.
Okay, I just want to stop Tony Irwin right there. I respect this gentleman, but I will say this, that the people and the members he represents do not lend to individuals who are only employed. So that is to say, some of their customers that they lend to are not employed, and that, I believe, is part of the problem. I believe that some of his members providing this service to individuals on fixed incomes is part of the problem, and why the public may have a negative opinion towards his members. And I just wanted to clear that up. And I don't know if if that was his intention or to mislead the council there, but some of their members are advancing individuals or lending money to individuals who are not employed. And I just thought that it's important to point that out, because that is a fact. And like I said, I want to show both sides of the story and opinions, but I also want to point out the facts. And that's an important fact. And I'll explain a little bit more about that later, why that's an important fact. But predominantly, the main reason is lending to individuals who are on fixed incomes, who don't have the ability to repay, is what skews the numbers in some areas and actually hurts the industry as a whole. Because those individuals don't have the ability to pick up a part-time job. They don't have the ability to work an extra shift. And quite frankly, their resources are a lot more limited than somebody who has the ability to be gainfully employed. So, without getting into that any further, I'll restart and allow Tony to continue here.
Who can't pay their hydro bills this month. For them, getting a payday loan from one of our members who treats them with dignity and respect is a better option than paying bank NSF fees and reconnection fees. CCFA supports fair and balanced regulation and strong consumer protection measures that are already in place at the provincial level by the Government of Ontario. All of our members hold provincial licenses and pay an annual licensing fee. Loan documents are reviewed and approved by the regulator. Provincial posters displaying cost of borrowing and a cost comparison to a credit card must be displayed in our member stores, and they are inspected and audited on a regular basis to ensure compliance. The payday loan industry in Canada is not growing. Since 2012, the number of licensed locations in Ontario has dropped from 960 to 789, and with a reduction in the maximum loan fee chargeable from from $21 to $15 per hundred, we expect to see more closures. As regulation becomes more stringent, two things happen. More locations close, and lenders will have to stop providing credit to those borrowers who have the lowest credit scores and therefore no other options. While I recognize the desire among some to simply shut this industry down or significantly reduce it, I would ask you to consider what will happen to that single mother or pensioner if they can't access credit from a safe, licensed, regulated lender, and because they have no other options, are forced to go to an unlicensed, unregulated, usually online lender instead. CCFA would instead encourage the City of Toronto to focus on encouraging traditional lenders, such as credit unions and others, to offer more affordable credit options on a scalable basis as an alternative. Thank you.
Thank you, Mr. Irwin. Questions? And Councilor Kachanis, please go ahead.
Thank you, Chair. There's a report this morning in the Toronto Star about a pay loan establishment that was paying people that were working, I can't remember the name, or just bring it up now. People were working on a temporary employment agency.
I remember the story. I didn't see it this morning, but I know it was in the media or some months ago.
Would any of your establishments, or for your association be involved?
No, that wasn't one of our member companies, and that's not, I've never heard of that kind of activity, and certainly it's not something that our members would
So who was the pay loan company that was?
I don't know the name, to be honest, Councillor. I'm not evading the question. I just don't know. But they were a provincially licensed company, but they were not a member of our association.
But wouldn't all the provincially licensed companies have to be a member of your association?
No, it's not
Self-regulating?
No, it's not mandatory. In fact, the speaker after me represents independent payday loan operators. It's not a requirement to belong to our association.
So let's talk about that mother, which is the single mother that wants to make ends meet.
Yeah.
She could.
Okay, so I'm just going to pause it right here. This counselor basically is trying to throw you off the scent of what the real issue is here. And basically, he's talking about something that has nothing to do with payday loans. And in fact, is just a poor operator that did something else that has nothing to do with payday loans that was in the media earlier. And I also wanted to point out some things that he's trying to put out there that are also incorrect and accurate, where he said that, he asks Tony, aren't your members self-regulated? Well, they're not. There's strict regulations in place that are enforced by the Ontario government, and the government regularly, as Tony said earlier, inspects those organizations and makes sure that they're compliant with the laws that are already set forth and in place in Ontario. But again, I feel like this counselor is basically already has a preconceived notion, is already determined that he does not like payday lenders. So he, scoured through the media to try and find a bad story or a negative story about one of them. And by the way, payday loans is simply one service that most payday lenders offer. So being a payday lender, doesn't encapsulate you as that only. So the company he's referring to may have had an employment agency as well, or may have been doing other businesses as well. He's trying to basically throw the whole industry under the bus because of one bad operator who happens to provide that service. But I just wanted to point that out, that this gentleman is already not very objective, and he's coming out of the gates with his preconceived notions already. And most of what this gentleman's going to say is definitely not fact-based.
Comes in to get a loan from you, and she gets $300.
Yeah, the average is about 500, Councillor.
How much is it?
500 is about the average.
500? And what
$500.
would you be hit with? What was the...
And so the fee is $15 per hundred. It's a fee-based product.
$15 per hundred.
So 15 times 5.
$75.
That's correct.
I mean, if I was to go to a bank and borrow money, the bank will not charge me more than 3 or 5%.
And if that single mother could go to the bank?
Again, you'd be lucky to get a loan from a bank at 3 to 5%. I don't know anybody. If any of you viewers can tell me that you've gotten a loan from a bank for 3 to 5% that's unsecured, I'd be happy to hear it. But I've never seen it, and definitely not in today's economy, but definitely not in previous economies. No bank is lending you any money for 3 to 5%. unless it's a mortgage, and that mortgage is generally backed up by insurance and also the property value itself. So again, this is another mistruth that this gentleman is putting forward to make payday lenders look bad, and really it's discouraging to see people in positions like this abuse their power with their ignorance. All we're asking city councilors to do, all any citizen should ask a city councilor to do, is be objective, go out and grab the facts, and then try and install policies in government that will help the people and make the city a better place. This gentleman is not doing that at all, but I'll let him continue.
She would. Or if the bank would extend her credit,
You are
she would.
then, you are facilitating the inability to go to the bank by charging 15%.
Yes.
Isn't that gouging?
Well, I guess you have to look at what the alternative is for that mother who can't.
Okay, Tony's going to try and do a good job here. What Tony should have done is refer to the cost of delivering the product. And some of the links that I'm going to provide, some organizations who've done the studies and the research have basically spoken to the cost of delivering the product. One of the more prominent reports was done by Ernst & Young in 2009, and they basically break down the cost of having to deliver the product. Among the costs in the pricing of a payday loan, basically Ernst & Young had found and confirmed that pricing of a payday loan was fair and reasonable. And the points I wanted to make here, that the rates back then when Ernst & Young done this report, completed this report, were at $21 per 100 as a fee. And at that rate, they said the price was fair based on the cost to deliver the product. Like any business, there's a cost to deliver a product and a cost to operate. And if you go to that report and look it up, they actually break down what the average cost is to lend $100. But things in there included labor costs, costs of goods, leases. And as most of you know, the costs of goods and leases and even labor have gone up significantly since 2009. So it's important that you consider those costs when you factor in what someone has to charge for a product or service, and to subtract these costs and the costs. Other costs would be the costs of capital to borrow money. Most of these companies aren't funding this out of their own private bank accounts. Some of them are publicly traded, so they're technically borrowing the money. Some borrow money from financial institutions. However, most financial institutions will not lend this industry money because they do believe it as competition, and I'll get into that further at a later point in this video. But you also need to subtract the cost of the consumer debt. Some of these consumers are going bankrupt, and some people will say they're going bankrupt due to payday loans, but I'm going to talk to some reasons why I believe that that's not true, and I'm going to also point out some facts, some reports that were done in North Carolina and Georgia in regards to these reports and these fees, and why the cost has to be what it is in order to make it profitable. Anybody who gets into business wants to make a profit, but these gentlemen and in this council, this gentleman particularly in this council is trying to allude to the fact that there's tons of money being made and the profit margins are way out of whack, and basically the consumer's being gouged, when in fact that's not correct. And a third party accounting firm like Ernst & Young, who's very reputable, in 2009 basically did a study simply on the cost of delivering a $100 payday loan to the consumer. Okay, so again, we'll continue.
Feed her kids. What does she? It's expensive, no doubt about it. But what's the alternative if you have nowhere else to go and you need to fix your car to get to work to get paid, or you need to be able to pay for a medical bill that's not covered under your benefits if you have benefits?
So if we put you out of work, then it will be the loan sharks it's the end of the world.
We certainly, and I didn't say it because of our shortened time, but we get more calls in our office now than ever before from people who go online, they call us to find out whether the company is licensed, if they're one of our members, because either they've been scammed or they think they're going to be scammed. So either it's companies who have no intention of giving you a loan at all, and they ask you for all kinds of fees up front. So we tell people never pay money to get money, or it's a circumstance where they will get a loan, but they'll get it at far worse rates. The company is located offshore. There's no recourse for law enforcement in Canada.
You help the people avoid those loan sharks, quote unquote,
Yes, sir.
at 15%.
Yes, sir.
Thank you, sir.
Councilor Bernstein?
Thank you. Through you, do you get a lot of defaults?
We do. There are a significant number of defaults. I would say, though, that our members work with their customers on extended payment plans, working out some sort of arrangement so they can repay that loan. The initial charge-off rate and the default rate are two very different numbers because our members recognize that people are in bad spots. And simply just saying your loan's in default and not being compassionate or trying to help them out doesn't serve anybody.
Well, it's not probably unsecured as well, so you're out of luck if it defaults.
Correct.
So the other question, I think.
Sorry. So this counselor is a little bit more objective, and he's actually trying to help Tony here because I guess he realizes that Tony dropped the ball here a little bit as well. And what he's speaking to is some of the things that I just spoke to about the cost of delivering the product. First of all, the product's unsecured. So it's not like a pawn shop, even though later on they're going to try and compare this industry to pawning something. And it's not like a bank or a mortgage where they have some sort of security that they can take as far as your property. And at 3%, that's the only type of loan that a bank's going to give you is if it is secured. So at that rate anyway. So this gentleman here, this counselor for Don Valley West, is basically trying to throw Tony a bone and tell him, explain to the people in the council as well, and also probably inform his constituents that payday loans aren't as bad as people think, and here's why. And I'm going to let him finish, but I just wanted to point that out because it's very important.
You said it was $500, and was it an average of 10 days?
The average term of the loan is about 10 days. The person repays it in
Right, so it's just sort of get people to the next paycheck or whatever the case is. And I would assume that one of the reasons the rates are perceived as high or are high is that compared to a bank that usually deals with a larger loan, it's also over a period of time where they have that upfront administrative costs covered over a period of time, whereas you still have the same administrative costs setting it up, but it's only a 10-day period. So that's right. That why it's one of the reasons it's reflected in that rate? It
is. The loans are costly to administer. There are collection costs or technology costs, the store infrastructure, paying people. There are all kinds of costs that go into it. The other one too, of course, is our members are not accessing capital from banks to lend to their customers. So our cost of capital is a lot higher than it would be at a bank also.
Right, you're not getting the overnight lending rate.
No, we're not.
That's what you're saying. Okay, and then the last question. So I was a little unclear, though, in terms of, I know you don't want the government to put your clients out of business, but in terms of this, the item before us, what's your feeling on the licensing?
Well, I think, and certainly the speaker after me will speak more because he represents smaller lenders for which paying a second licensing fee on top of what the province charges us could well make it more difficult for them to operate. They are small business people. It affects my members too, but they're larger, so perhaps it's not as onerous. One thing that I would say, and Councillor, thank you for asking, that we're concerned about is there's a recommendation that licenses be non-transferable. So if someone has worked hard, created a business, invested in the business, and then wants to sell it, they're unable to do so according to this proposal, and I think that's problematic. I don't think that's fair for someone who may want to sell that business to someone else who wants to operate it, but under this proposal they would not be allowed to.
Okay, so I got 30 seconds. Why do you think they made it non-transferable?
Well, I presume because there's a desire ultimately to reduce the number, and if you can't transfer the license.
That's the end game.
I presume so, yes.
Okay, thank you.
Any other questions? Deputy Mayor Rivera-Maker, please go ahead.
Thank you, and through you, Mr. Chair, and thank you very much for coming in today. And I'll have to say, I'm wrestling with the whole report and all the things that are contained in it. And you mentioned the single mother who might need some help and gets the payday loan. I'll say your perspective is having these payday loan companies actually helps the single mother.
Absolutely.
But you make her poorer by going to your members. than if she went to a credit union.
All right. Every business, everywhere in the land, makes people poorer because they're paying for things. And by that logic, he's correct. Anytime you use any service and do something that you're not doing with your own hands or providing for yourself, there's a cost associated with that. So every time you go to the grocery store, it could be argued that the grocery store is making you poorer. Anytime you drive your car, it could be argued that the gas station is making you poorer, or that your car is making you poorer, or that the dealership that sold you the car is making you poorer. I know he's trying to say that this is an expensive alternative, but again, he's not armed with the facts, obviously, because if you look at the facts at the various reports by various individuals all over the world, not just in Canada, but some of these reports were conducted in the United States with a much larger pool of statistical numbers included in there. I think it's important that these counselors really start looking at the facts and focus on the facts as opposed to their opinion. But that statement I had to debunk. I mean, everything makes you poorer, technically.
Or a bank.
If they would extend credit, I could agree with you, but they won't extend her credit.
So would you agree that, again, I would think that the best way we could help that single mother you gave as an example, if there was some way to keep her out of your stores, everyone would be happy, because that single mother would be better off financially if she never stepped foot in your stores.
I think that more options are always better, Counselor. I think more options are always better. And if I've had this conversation with United Way representatives and across other parts of the country who have said essentially what you just said. But they went further and said, but we're not there today. We'd love to live in a world where you guys aren't needed. But that's not where we are. Maybe a day will come when that's the case. But until that time comes, we need this industry because there are not options for people. There are not a range of options.
So we'd all love the day when we don't need to borrow money from anybody, including the banks, our parents, or anybody for that matter. But he's right. We're not there. We're not close to being there. And again, it's important people remember this is a service provided by a for-profit business that needs to operate, needs to hire employees, needs to pay rent, needs to paint the walls, needs to provide tile on the floor. So yeah, it'd be nice if people didn't have to borrow money and everybody's pockets were full and flush and they could afford everything that their hearts desired without having to go and borrow it from somebody. But that's not the way society is today, and I don't think society's going to be there for a while. So the reality is people do need to borrow money to make ends meet from month to month. In fact, there are studies out there that say 50% of Canadians are living paycheck to paycheck. And there are higher numbers that speak to consumer savings, and 70% of Canadians don't have adequate savings. And that number is very broad, but there are factual numbers out there. Go get it. I can't quote it specifically, but I don't have that good of a memory. But the numbers are in that range, and I'm sure most of you have heard those numbers before in the media. But those are statistical facts, and yeah, it would be nice when people didn't have to borrow money, whether that's for free from their family or at a cost, for sure. I'm sure most people would love to live in that utopia, but that's not a reality. Or is it realistic at this time?
Options for that single mother that all of us in this room, or most of us in this room, could avail ourselves to at any given moment. They cannot.
Okay, great. Thank you. Thank you, Mr. Chair.
Thank you. Any other questions? If not, I have a couple questions.
Sure.
Don't you think that these financial institutions are preying on the most vulnerable people out there, and people in need, the poor, the most disadvantaged, that they cannot, literally speaking, open a checking account in any financial institution?
I think that what's common amongst all people who use our industry.
He just said something totally inaccurate there. He said we service consumers that don't have checkings accounts. That's not true. As Tony stated in the beginning, his consumers need to have a bank account. And he also said they need to be employed, which I said is not true, because his members do service individuals who are not employed. However, they do need a bank account in order to get this particular service. So there's going to be a lot of things that I'm going to correct that this counselor has to say. And again, you're going to notice how he's going to get off topic and talk about things that aren't related to payday loans whatsoever, or this particular motion or policy that the city of Toronto is wanting to implement.
Is they have been told no everywhere they've gone. They've gone to a bank, a credit union, family and friends in an emergency situation, all of whom have said no, we can't help you. And then they're left with, what do? And they come to this industry because this industry says yes, we will help you. It is not.
So I want to stop Tony there. Tony's his intentions are good here, but again, some of this is not fact-based. Not every single customer that goes to a payday loan outlet store is there because they have no other options. In fact, some of them are very smart and very intelligent when it comes to their financing, and understands that this is a better alternative than utilizing their overdraft or utilizing other various forms of credit. And it definitely allows certain individuals to keep their dignity. I know myself, when I've had shortfalls, I don't like to go to friends or family and ask them for money. And if I had some alternative to go and even pay a fee, whereas my friends and family might lend me the money at no cost, I'd prefer to pay the fee in some of those circumstances. So this is a conscious choice. I would argue that most of the consumers that consume this product are educated and understand their options. And I think it's important that people understand that this is a financial tool that the consumers decided to use for various reasons. But to say or argue that this is their only option, that they have no other choice, I firmly disagree with Tony on that. And I believe there are many others that firmly disagree with that statement, predominantly the customer, because how dare anybody say to the consumer that walks into one of these stores that they have no other option and that they're desperate? I mean, that's ridiculous. That's not the case at all. And to say that they're uneducated or poor is another falsity. The reality is the consumer, like Tony said, are represented by various individuals, most of whom are educated. Most have an average household income of $120,000 or more, and have very good jobs. Now, I was tempted to say very good high-paying jobs, but we know that there are very few very good high-paying jobs. Those jobs and those consumers are made up of nurses, teachers, police officers, firefighters. Now, I don't know anybody that wouldn't argue that those individuals should be paid more for what they do and the service that they deliver our society. But that's not the case, and that's not where we operate. And this is leading into another point I'm going to make later, that there are more serious problems going on in today's society than payday loans and the payday loan industry, or the banking industry as a whole. And there are more systemic issues inside this country and inside Ontario and inside the city of Toronto, and issues that are more pressing than this. But these are the things that the government is deciding to focus on because it's easy to do so, because it's easy to bully the payday loan industry, because it's easy to say it's 390% as an APR, when in reality it's a service fee for a service that's provided for a short term. And I would argue that nobody could show numbers that customers are utilizing this product for every single pay period within a year. Therefore, an APR, an APR stands for annual percentage rate, would not apply to this particular situation. And if you were to do that to a whole whack of other products or services, to do that, I mean, if you were to apply an APR to a whole whack of other services, then I would argue that most products are well above 390%. Most products and services come in well above 390% when you put an APR on it. So, Tony, again, is trying to do his best here and represent his members. My company is not a member of his organization, but I will tell you that what he's saying there, I have a big issue with, and I totally disagree with that our customer is incapable of getting help anywhere else. I think they are. I think they're making a conscious choice of where they want to borrow their money. And they're also well aware of the cost because they're educated individuals, and because of the regulations, the way they're laid out, it's very clear what the costs are, and people are budgeting that into their financial budgets, and they understand what they're doing. So, I personally am getting sick and tired of people claiming that the consumer is an idiot and doesn't understand what's best for themselves and doesn't understand how to take care of themselves, because the reality is majority of people are intelligent and understand and are educated in Canada anyways what their options are, and know what's best for them as a consumer. So I want you to contemplate that, because painting the consumer, our customer, as uneducated and incapable and desperate is one of the biggest falsities I've ever heard. And again, I think it's because the big guys don't understand who their customer is at all. The fact that they would let a representative of their industry say such a thing is actually quite disturbing, because I think that's part of the problem, and that's part of what causes the narrative to be allowed to go this way, and that is to say that these people are desperate and they have no other alternative, because there are plenty of other alternatives. And I'm going to argue to say that this is not their last hope, and these industries are not their last chance at obtaining or securing a small loan, whether that's from friends, family, even the bank, even their lines of credit cards, and such. So without further ado, I'll let them get back at it.
There's not in our industry's interest to loan people money every 2 weeks for the whole year, to loan them more money than they can repay. It wouldn't be a good business model if we were to do that. So it is in our interest to try to loan the right amount of money to the person who comes in, an amount that's sustainable. That doesn't mean we're perfect. I wouldn't say that we're perfect. There are circumstances that should be improved upon.
We do have people in the construction industry, for example, undocumented workers, and who are doing precarious work at the same time, and not having, and decent people that are paying taxes, they're working, their kids are going to school, but because there is no alternative for them.
I'm sorry, but how can you be undocumented and pay taxes? Maybe I'm ignorant here. I don't know if that's possible. Maybe somebody can leave a comment on how that's possible. But again, my understanding, if you're undocumented, you can't be paying taxes because you have no documents, and technically you're working illegally. Again, what this counselor is talking about has nothing to do with this industry, but I just wanted to ask that question and point that out, because he's trying to draw this issue into some other larger, bigger problem in society, and it absolutely has nothing to do with our industry. But he felt the need to bring it up. I had to ask the question.
And the only option that they have is to go to these financial institutions, the Payday, where is if you were on the other side, how would you look at this?
Well, and it's an interesting question you raised, Counsel. I mean, I've talked to people who have used the service. I have gone out to stores, I've talked to customers, and they've told me their stories, and they've explained how, they understood that being in this is not intended to be a 26 week of the year situation. They would come in, they would get the loan, they had jobs, good jobs, but I think we could all agree Ontario is an expensive place to live, and Toronto is an expensive city to live in, and it is often not enough. So they would get a loan, they would gradually then borrow less,
Thank you.
try to get themselves out
I
of
have
it.
just a few more seconds. With regards to the locations,
Sure.
why is it that these Payday locations are very close to, let's say, to bingo halls and places where the most vulnerable people go there, and they become victimized twice, not only in terms of betting, going to bingo halls, for example, but also they had to pay a heavy price by giving up or selling their paycheck in advance. How do you see that?
Okay. Again, he says most of these places are located near bingo halls. No fact to that whatsoever. I'd love if you had a pie chart or some sort of Google map that could say, majority of the payday loan places are located near bingo halls. Again, bingo halls are licensed by the Ontario government, and if I'm not mistaken, bingo halls are not for profit, and the money that they do make goes to charities, selected charities. Again, he's trying to paint a narrative of who the customer is that they're basically bad with their money, they're gamblers, and they run off to bingo halls and spend all their money. So they're being victimized by the bingo hall, and then right beside them, right outside the bingo hall, stands a payday loan store where they can go get a payday loan to, lend them the money that they lost, so that they can basically pay for their necessities of life. This has got to be one of the biggest mistruths that I've ever heard about the consumer, that they're basically so bad with their money that they run off gambling it away, and because they have no other way to make ends meet after they wasted their money at a bingo hall, no less, they're running to a payday loan store to make up that difference now. Again, this guy says things like this, and he backs it up with actually no fact whatsoever. And again, he's trying to speak to the narrative of who the customer is, and that's not who the customer is at all.
Is there some level of conscience somewhere?
There absolutely is. I would take issue with the victimize language. I don't think we victimize or prey upon people. We help people who can't get it elsewhere, and this is an option for people. This isn't like auto insurance where we all have to have it, and we may not like it, but we have to have it. This is not the only option. We welcome as many options as possible for people. Our industry locates where people can get to, that's easy for transportation. Lots of other retail businesses where they can find space. There's all kinds of reasons, but we don't look at some of the reasons that some accuse us of doing. That's not how we decide where our stores are going to be placed.
I was referring to the location.
So the narrative here is that payday loan stores operate in poor neighborhoods or near gambling establishments, and that's because they want to prey on people who've already been victimized by either society because they're not making enough money, or the bingo halls or gambling establishments that were set up by the government, by the way. But the reality is there's an old paradigm out there that exists about the payday loans establishment, and that is National Money Mart, or Money Mart as they're called today, basically established check cashing outlets in some of the poorer neighborhoods years ago, more than 20 years ago, because banks were not in those neighborhoods and people had no place to go and cash their check. Now, it's important to understand that those stores were built and established before payday loans were introduced to the Canadian market. So there is an old paradigm that payday loan stores are predominantly in poor neighborhoods. They're right in the sense that National Money Mart, or Money Mart, is in a lot of the poorer neighborhoods back then, and most of those stores still remain open today as the economy has changed. Some of those neighborhoods are not poor anymore, but it's important to understand that that's an old paradigm, and it was established before payday loans were out, because these businesses were established in poorer neighborhoods where banks did not exist or did not service the customer. So I just wanted to point that out because I think that's important to know why you might see some of these stores in poorer neighborhoods, or in neighborhoods where it's predominantly individuals living on fixed income, like government-assisted housing areas and things like that. So it's important to know that.
One after the next within a radius of 1 kilometer, you have too many. My last question is, hopefully you can answer this quickly.
Sure, I'll try.
It's been legislated that the pay shouldn't be more than $15. Why is it that all the signs all across the Payday locations are still $20, and they keep on charging that. And that was supposed to be retroactive to January the 1st of this year. Why is it that we keep on?
I hate to destroy this guy like this, but the reality that this guy's talking about is non-existent. The posters he's talking about are posters, advertising posters by a company called Cash Money. And what they're advertising is that on your first loan, if you decide to go and get a payday loan with them, they're only going to charge you $20 for your first $300. So you can get $300 from Cash Money for 20 bucks. And those are the posters that he's talking about. So he's assuming that those posters are indicating that they're charging $20 per 100, even though the law was changed in January of 2018. The Ontario government changed it so that the maximum allowable charge is $15 per 100. So he's assuming that those posters are advertising that they charge more than the legal amount allowed. Again, he's just misinformed and he hasn't done his research, and it's very disheartening to see government officials say things like this because they haven't done their homework and they haven't looked into what they're trying to say. And he's basically jumping on the bully bandwagon here to bully this industry into hiding its head in the sand or moving everybody online because they don't want to see them in their city anymore. The reality is this guy's misinformed and he's spreading another mistruth. And he's going to go into some more mistruths here, and I'm going to debunk them right away. So let him continue.
Well, you're talking about the signs that are advertising for
Yes,
lower rates?
which would be misleading.
Yeah. Well, those are rates that companies, promotions that they offer. Why are they doing that? Because the province hasn't said that it can't happen anymore. I would say that during the last round of review with the provincial government, we recommended that that no longer be permitted to occur. The provincial government did not follow through on that.
Thank you so much.
So what Tony's saying there is his association went to the government of Ontario and suggested to them not to allow business to advertise discounted rates for the consumer because their members have so many stores and they don't want their customer going anywhere else. Of course, why would they? And most of the companies out there who are introducing a discounted rate or a lower rate for the consumer, which is great for the consumer if they can get a lower rate or a discounted rate, the reason he doesn't want anybody to advertise that is so that they can't lose their customer who is not getting a discounted rate. Because if a new company pops up and they're offering a discounted rate to capture some of the market, that's good for the new company, but it's bad for the people he represents. So that's why they would have asked for something like that, just so you know. The association, the guy's paid to look out for his members, and his members don't want their customers going anywhere else. That's obvious, and that's why they would push for something like that. But definitely, if the consumer doesn't know what their options are out there, I would argue that that's bad for the consumer not to know that there's somebody cheaper out there or that there's a better rate for them. So we'll continue to go on with this video.
Thank you.
Patrick Mohan Omohan, next speaker.
Now, full disclosure, my company, Payday, is a member of the Independent Payday Loans Association. Patrick Mohan, the guy about to speak, is the president of that association. I'm going to have some criticisms for him as well. Again, I do believe that these two gentlemen missed some very valid points, and in part that's due to the fact that they were kind of ganged up on, and some of the questions really didn't pertain to what they were there to speak about. So they were taken off guard, essentially.
Sorry if I mispronounced your last name. Good to have you here. Thank you
Thank you very much. Yeah, my name is pronounced Mohan, like mowing the lawn,
Thank you.
but that's okay.
You have 3
I
minutes.
don't care what you call me, just don't please call me late for dinner.
Sorry to keep you waiting. Please go ahead. 3 minutes.
Hi, thank you. My name is Patrick Mohan, and I'm the president of IPLAC, the Independent Payday Loan Association of Canada. We represent all the little guys, unlike Mr. Irwin, my predecessor, who represents the larger companies, the money marts, cash monies. Based on regulations, both provincially as well as now locally, being imposed upon us, I'm sure you'll naturally see a reduction in license renewal from our membership. Little guys can't withstand the additional licensing fees and the lower rates. It's just impossible. Larger companies can because they have scale. It's like banking. Based on their size, Money Mart and Cash Money, the big guys, are not affected by these punitive legislative and regulatory changes. They have deep pockets and now are offering installment loans, which we're avoiding as it becomes yet another long-term debt for the same consumer, adding to other long-term debt they currently owe to banks, credit card companies, further putting them into harm's way. As we've argued, our fees are not and should not be looked at as an APR, since nobody I'm aware of ever borrows 26 pay periods per year. According to Ontario government stats, on the average, consumers will borrow 6 times annually. Having said that, installment loans get the consumer into a long-term debt, perhaps never to be repaid, which is precisely the point for the lender. Just as in the case of Visa and MasterCard, the banks never want you to repay the full balance on a monthly basis. They have even deeper pockets than the money marts and cash monies. They want their money fully deployed all the time to maximize revenue. If you have a Visa balance, for example, of $1,500, and you only pay the minimum payment, which well over half Ontarians do, it will take 67 months to retire that balance, and the interest will be $1,172.67 over those months. Having said that, with reduced access to payday loans based on fewer proprietors and locations, consumers will always find another way, and in this case, they'll be utilizing, as Tony Irwin said, online and largely unregulated lenders from offshore to meet their individual needs. If we're not here, regulated, licensed, and overseen, who knows what's going to happen to the consumer? They are going to obviously be in a much worse position than what the perception of some people is now that they're in. One example for you to consider as well is hydro bills. If you are in a position where your hydro is terminated, disconnected for non-payment, of which 60,000 consumers in Ontario were cut off in 2015, it will cost $120 for that disconnection and another $120 to be reconnected.
So what he said here was, in 2016, I believe he said, 60,000 people had their hydro cut off. Now, my argument is going to be this. Most people who have their hydro cut off are more than one payment behind. I'd like to think that Toronto Hydro doesn't cut people off after, being 1 month behind. But even if they were, you're free to go to the Toronto Hydro website and check out the disconnection fees, because they are quite high. And for people who are in remote areas, the disconnection and reconnection fee is even higher, as high as $900 to reconnect your hydro. So if you found yourself in a position where you were a few months behind on hydro and it was going to get cut off, and borrowing $500 would stop that from happening, it's definitely a better option to do so than to allow it to be cut off, because you will be put into a much worse position. But again, I don't think that people are utilizing their payday loan product or service to cover a hydro bill, but they might be doing that to prevent NSF fees if it's on an automatic withdrawal, or if they wrote a check to hydro to cover that bill, and that check was possibly going to bounce because they had a shortfall in income that pay period. That's when they would probably use a payday loan. And again, everybody's circumstance is different, so I'm sure you could paint a picture on any end of the spectrum. But I definitely encourage people to go to the Toronto Hydro and look at what the disconnection rates are for that, or even for your cell phone and other services that people might consider essential.
$400 bill, that would have cost $80 at $21 100, and now it's going to cost $60.
Thanks, sir.
Thank you.
questions, and a few questions, and we'll start with Vice Chair Karijanis.
You represent the independent individuals.
Correct.
I asked the same question of the person that spoke before you. There was a story in the Toronto Star. Are any of those independent individuals the ones that the factory is using to pay the workers?
I'm not aware of that article in the Toronto Star. I was here at 8 o'clock in the morning, and I have not read the Toronto Star today.
All right. Your organizations, they charge 15%?
No.
$100?
We charge $15 per 100 borrowed.
And that's for how many weeks?
Largely, it's a biweekly loan. About 30% of our customers are paid monthly.
So if that was to be put bi-weekly at the $100, you end up making 390% for over a year.
If, in fact, someone was to borrow 26 pay periods per year,
No, but
that
your
would be.
$100 will generate, when you keep putting it out there, will generate 390%, circling different borrowers.
Correct.
Thank you. So what's the difference between you folks being legitimate and a loan shark? I don't think the loan shark would charge 390% per year.
How can he compare a legitimate legal business to a loan shark? I've never used a loan shark, but I'm pretty sure if you used a loan shark, there's collateral that they're going to imply. I mean, everybody's watched, the gangster movies and whatnot, and we all understand what happens when you don't pay a loan shark in the movie. But I just want to point out, look where he's pointing this narrative and where he's directing it. And he's trying to associate these legitimate business people, myself included, to loan sharks. And there is fundamentally no backing for that, and there's no reason that he should be doing that. First of all, I'm not entirely sure why these gentlemen are even talking about the rates in the city council meeting. This city council meeting is simply about the number of payday loans establishment in the city and how they perceive them to be an eyesore, and they don't like the fact that they open up around each other. Despite almost every other industry doing the same thing. Burger Kings and McDonald's are opposite corners of each other, along with Harvey's and A&W. Most of the major banks are all on opposite corners of each other and all huddle around. Generally speaking, most businesses like to go into areas where there's high population, high traffic, and high visibility. That's the same for all businesses, people. So that's not unusual, but he wants to paint you a different narrative, and he wants to compare this to illegal lending. He shouldn't be doing that. That is my opinion. But again, I'm trying to show you what his narrative is and his preconceived notion coming into this council meeting. The man should be objective, and quite frankly, he's not.
That's the only difference.
First of all, we do not have customers that are in any way intimidated or are forced to pay anything other than what our stated rates are. And as I stated clearly before, everyone from utilities to Visa rates. You could also ask why Visa is 23% when the Bank of Canada rate is
Visa is 23% per year, not 390%, correct?
Yeah, correct, and they never want you to pay it off.
So credit card rates, when you actually look at the APR on it, because you can apply an APR to it, and the time it takes to the average consumer, again, going by factual numbers, the APR is much higher. And one of the links I provide, if you go in there and you look at the research that was done, there was a report done in regards to that. Now, there are several reports done by several different organizations. Ernst & Young's did one in 2008, I believe, or sorry, 2009. Stigman and Ferris did one in 2003 in North Carolina. Morgan and Strain did one in 2008 in Georgia. Morris did one in 2011. Bertrand and Morris did one again in 2011, which is P.1889. and Buta did one in 2014, and then Sikba and Tobakaman did one in 2006, and the CRC did a report as well. In some of these reports, they show the APR on a credit card over the average lifespan of a credit card, and when you actually look at those APR rates, it's quite astonishing, but they're much higher than 390%. So I will allow Patrick to continue here.
You know, I was reading a story, CNN, and this was Amanpur, and it reads, "Farmer sells wife to pay debts in rural India." That says to me a lot. Thank you.
It says a lot to him, but it's not saying what it should say to him. And in India, they have no licensed payday lending or any other proper payday lending establishments in those areas. So he's referring to a story that came from the CNN of all places, and we know how accurate they can be. But he's comparing it to some travesty that happened in India where a gentleman apparently sold his wife, if that's even true. However, it strengthens the point that payday lenders are required and needed to prevent things like that. And I could assure you, if India had an established payday loan industry like ourselves, things like that wouldn't happen and wouldn't have to happen. So we'll allow him to continue. He will go back to that story later.
Thank you. Is Councillor Burnside next?
Thank you. Through you. I think we heard from Mr. Irwin or somewhere that the number of payday loan operators actually decreased.
Yes.
And I believe that was before any sort of government regulation. It's just how business has gone.
No, since the Ontario government reduced our rates to $18 as of January 1st, 2017, and then $15 per hundred as of January 1st, 2018. Largely the independents in our association have turned in their licenses or not renewed.
Sort of faded away. Okay, so and that number, quote me if I'm wrong, is somewhere around from 900 to 700, give or take.
Somewhere in that area.
So about what's that? 20%.
Yep.
Somewhere around 20%.
So just to stop right there real quick, the reason these places are closing down is these small operators who don't have larger pockets and don't have the same efficiencies as a larger business can't afford to continue to stay in business, and that's because of the cost of delivering the product. So I'll refer you back to the Ernst & Young report in 2009, and basically that study breaks down what the cost to deliver a $100 loan is in the same fashion that a payday lender would do that. And the reason that these lenders are closing down, or the number of payday lenders are closing down, especially the smaller ones, is due to the fact that the government of Ontario has regulated it, in some cases, beneath the cost of delivering the product, essentially making it unaffordable for these smaller lenders to continue.
Percent. Okay, so I'm a pretty simple person, but if the rates have gone down that you're able to charge, and albeit they are high, there's no question about that, but if they've gone down and operators have gone out of business, this idea of gouging might be a little bit hyperbolic.
I would tend to agree with that. We do not gouge.
Thank you.
Thank you.
Again, it seems like this counselor's being objective, and he's trying to help out Tony and Patrick here by basically saying, look, the rates have been reduced. Obviously, some of them have closed down as a result of that. So obviously, they weren't gouging. They weren't charging a higher rate because people were desperate and had no other choice. You know, it's kind of like, you know, you own a water store and there's a big drought and nobody has any fresh drinking water, so the price of water goes up. That's not what payday lenders are doing, and not one of them are doing that. And they're basically charging what they need to charge in order to show a profit, to be sustainable, and to continue on doing business and provide the service for the community.
Any other questions? If not, I do have a question. And you did mention that these payday locations in loans usually are no more than 5 or 6 times a year. So my question to you is, and I know this from people that they have complained directly to my office, and I've seen them, undocumented workers. Undocumented workers that are within
Here he goes again.
construction industry. They have no other place to go because they are undocumented. They don't have the legal documents to open a checking
I'm sorry, I
account.
can't hear.
I'm talking about undocumented workers that they don't have the paperwork
Yes?
to open a checking account with a major financial institution. So
Again, none of the payday loan operators service customers for a payday loan without a checking account. It's mandatory. They have to have one.
these undocumented workers, literally speaking, for example, I'll give you a location, St. Clair and Northwestern Road, one of them. They go there for every single paycheck that they have. And that means 26 times a year.
What this counselor is referring to is an individual that spoke to him that goes to apparently an establishment that's located at Western Road in St. Clair to cash their check, which is a different service and it's a different fee for check cashing. Most places charge anywhere from 1% to 4% to cash a check. That number has been relatively the same for over 30 years, so it's virtually been inflation proof. Again, not pertaining to what this city council is supposed to be looking at, but they are trying to paint a negative narrative so that they can get the voters to vote their way based on this misconcepted narrative.
So how do you explain that? Where is the rationale
So the
to your
26
comment?
So I'm hard to hear.
Councilor Nunciara, if, please.
So I heard, I think I understand what you were asking me, but, so you're saying that undocumented workers would receive a paycheck?
As an example, yes.
And they would go to a payday loan outlet, and they would cash this check that they get?
Because they have nowhere else to go, and
Because they don't have a
created
bank
some
account?
sort of bond with that.
Because they don't have a bank account? Am I following
That's
that?
right.
Okay. So that's a different product. That's called our check cashing product. We also cash checks. So that we do for 2.9%. So if you have a $1,000 check, it's going to cost you 29 bucks.
$29,
Yeah.
okay.
And if you have a $100 check, it's going to cost you $2.90.
Now,
Cash the check.
now, if you lend them in advance, and then they have to pay $15 for every $100.
For a loan, yes. That is for an extended period of time. For example, the banks will hold paychecks. If
No,
you
no,
go
I do get it.
Right.
I do get it. I know what I'm talking about from that perspective.
Yeah.
What I'm trying to get at is to the 390% interest, literally speaking, that most of these people are paying, but somehow it's being justified. I'm trying to understand.
It's not 390%. No one borrows 26 times a year. If you have a paycheck,
Sir, I
you're
can
not paying
assure you
15
100%, and I'll be speaking at City Council on that. Thank you. Thank you for your presentation.
Thank you.
Donna Borden? Donna Borden? Oh, great.
So this lady represents Acorn, and they're constantly at these things, advocating to restrict and limit payday lenders and other lenders and banks and credit unions. They basically are advocating for, to sum up what she's going to talk about, is they're advocating for lower costing alternatives for their members. Now, most of the members that Acorn represents are on fixed income or are in the lower income bracket individuals, And Acorn has a very valid point. There should be more affordable options, and those affordable options should be established and provided by businesses that are making billions of dollars and can afford to lend products at a lower rate. But again, they're not going to do it at a loss. Okay, businesses are not going to do it at a loss, and banks definitely are not going to do it at a loss, because banks are publicly traded companies, and a vast majority of individuals who hold stocks hold bank stocks, and they're not going to want the banks to discontinue profits in order to provide a lower rate loans or money, make lower rated money available to individuals. So there's a systemic problem out there with fixed income individuals and lower income brackets. And one of them, which I encourage you to look up, is something called the welfare wall. And one of the conservative MPs in the federal government is proposing a bill. Go look into that, and that bill would allow people who are in these fixed incomes or low income brackets to go out and get basically a job or a part-time job and earn some money on top of whatever they're getting from social assistance or the Ontario Disability Program or whatever program they're on federally, so that they can actually climb out of poverty. And that's very important. And I think that when I was speaking earlier, I said that there are more important things that should be done or can be done to help society as a whole. One of those things is getting rid of that welfare wall. But look up welfare wall and go and look up what that is, and that's really who this lady, I believe, is speaking for and trying to protect. I agree with most of what their argument is. They are also, though, misinformed, like some of the other organizations, about what payday loan companies do out there. There are some bad payday lenders out there that are going to advance individuals on fixed income more than they can afford to pay back. And in fact, my company has taken a stance where we do not lend individuals on fixed income because they do not have the ability to climb out of the cycle, and we don't believe that a payday loan is the right product for them. And I would suggest that there are other programs out there to help those individuals in need, as opposed to a payday loan or any loan for that matter. And I can tell you, I speak on that from a very personal position, and very familiar with growing up on in a family with fixed income. So I would encourage you to go look at the welfare wall and support the MP that's putting forward that bill to end the welfare wall and allow people who are on fixed incomes to basically generate an alternative income to help them climb out of this poverty that they're in. But I'm going to pretty much skip over this lady because she's basically going to speak to things that, again, don't necessarily apply to this. But she's going to speak on, having banks be forced to lend people money at a lower rate, especially people in the financial group that she represents. And again, like I said, it's a publicly traded company, and most people who invest in stocks are not going to allow that to happen, unfortunately. So we'll just
Scattered
let
all
this
over the
finish
place.
up here.
Almost every plaza in Scarborough has
Yes.
a payday loan company. Why do you think they can make money with their little offices, which I hardly ever see anybody in, with their low volumes? Why do you think they can make money, but a bank can't do the same thing, or a credit union can't do the same thing?
Well, I think the banks could do the same thing. They just, for some reason, don't want to focus on, they feel it's a big risk. The banks, a lot of the banks invest in a lot of these companies too, what we found. But they just feel like they have to charge, they don't want to take the risk. I think the banks don't want to take the risk, and they don't want to provide the services. I think they can. They just chose not to.
Okay, great, thank you.
And again, they don't want to provide those services because, unfortunately, it is not profitable as the banks would like. They see much higher returns on other products, and that's where they're focused. Their investment dollars are on things that actually turn a higher profit. And I would suggest to you, if you want to compare apples to apples, go look at National Money Mart. Money Mart is a publicly traded company. I believe it's under DLLR in the stock exchange. And then you have Cash Money, who's also a publicly traded company. And they're owned by a company called Speedy Cash in the U.S. The National Money Mart, or Money Mart as you will, is also owned by a U.S. company. And they are also publicly traded. And if you go and you compare, because when you're a publicly traded company, your earnings statements are readily available. If you go and compare the earnings statements of any of these payday lenders and compare it to a bank or an insurance company or anybody else, for that matter, providing service, you're going to see that payday lenders and check cashers are not making that much money, and they're not gouging, if you will, and their earnings statements speak to that. And again, the numbers are the facts.
Thank you. Any other questions? If not, thanks so much. And we are done with the deputations now. We'll go to questions to staff.
Now they're going to go into their statements. This is going to get interesting.
If, in the interest of time, okay, that's great. Speakers, Councilor Sierra, and
Very quickly,
Councilor
just wanna
Wantam,
thank-
please.
Yeah, thank you very much. I want to just thank staff for their work so far, and I want to also thank and acknowledge the leadership of Councilor Nunziata, who I recognize has moved multiple motions over a grand stretch of time, and that goes into years at this point in time, trying to get in front of this issue, but also knowing that there are limitations around jurisdiction of who actually has control over this particular sector. And I know that it's not been necessarily easy, which is why it's taken so long. But I do want to acknowledge that we've reached a milestone at the very least with this particular report, and hopefully with the next phase of work to come. Because in the communities that I represent, oftentimes when people think of Toronto Centre, Rosedale, they think of Rosedale or they think of the wealthy parts of Yorkville. But I also represent communities that we have one of the poorest postal codes in the entire city in the downtown east, and much of the commercial activity that I'm now seeing along Yonge Street has been somewhat discouraging. And what we've noticed is that there's been a dramatic increase in criminal activity at the same time as we're seeing the payday lenders come into our neighborhood, as well as the pawn shops, and it has not gone unnoticed in our neighborhood. So I do think that.
Again, the narrative that she's trying to paint, one thing has nothing to do with the other. There are no statistical facts out there that coincide an increase in crime with the opening of payday lenders. That may be a statistical fact that there are a larger need for payday lenders and other forms of lending institutions as the economy finds itself in worsening conditions. But again, she's speaking and trying to paint a narrative that just doesn't exist. And she's also compared a pawn shop to a payday lender or a microfinancial institution, which just isn't fair, because the reality is pawn shops are purchasing items and they're going to start referring to items that were stolen from them, times that their homes were broken into, and she's going to suggest that a police officer told her to go and look at go and check out the payday lending stores. Really, what she was probably being referred to is to go and look at the local pawn shops. Now, I do know that some National Money, or I keep calling them National Money Mart, but there are some money marts out there that offer pawning services, and they may have been referring to that in all fairness. However, most of these microfinancial institutions do not do pawning, and the ones that do, again, that's a different service, and pawning is a totally different service and doesn't have anything to do with with microfinancial lending.
But there is a requirement for more a clearer regiment of regulations, but also what we are looking at is the systemic issues of people who are precarious, who are low-waged, who oftentimes are underbanked, which is why they're in this situation. And the last thing that we need to do to them is make them pay more than the average citizen, and also to confine them further into this spin cycle of poverty, which is grossly unfair. So they do need greater consumer protection and not.
Thank you. Absolutely. Absolutely. Thank you, Councilwoman Tam. The next speaker is Councilor Musiara. You have the floor. So now both of them are synchronized. I just did it. Okay. Let me start for you again.
Yeah, thank you. So I'll move the recommendations in the staff report, but I also have a motion. I'm not going to read it all out to you, but it actually just in the briefing note that we received from Acorn. So it's actually the recommendations that were moved by Acorn. So that's all incorporated in my motion. So I'm not going to read it out. So members, if you will recall, a couple of years ago, that Councillor Wong Tam, it's in the briefing note that you have here. That's what it is. Councillor Wong Tam and I put forward a motion in council, and it was carried unanimously on the issues that we were having with payday loans, and maybe it was longer than that.
Again, if you look at this motion, most of this pertains to other industries, other services, and other levels of government. So in this motion, they're talking about requesting the Ontario government make some changes to the existing licensing that's in place and some of the existing law and its framework. Now, the Ontario government has just revised the framework and has recently changed some things within the legal framework of the Payday Loans Act. But they're also in here talking about approaching the federal government about lowering the maximum interest rate from 60% to 30%. It's actually 59%, but they said it's 60, and they want to lower it to 30%. So, you know, in the criminal code, it says the most anybody can charge somebody for in interest is 59%. Or maybe 59.9%. But again, this stuff in here in this motion really doesn't pertain to this particular council meeting and what they were talking about. What they're discussing at this city council meeting is they're going to make some proposed changes. What they want to do is put a freeze and a cap, not allowing any other payday lenders to open up or obtain licenses in the city of Toronto. And they basically don't want anybody who currently owns a payday loans company to be able to sell that company because the license wouldn't be transferable. Now, this is a proposed 1-year freeze, and they're going to implement this so that they can, in a year's time, come up with some legislative framework that's legal and I would propose to say that that they're going to try and make it fair. Fair for whom, I'm not sure. But again, it's very reactionary, and it's reactionary based on the recent changes from the provincial government to the Payday Loans Act, allowing municipalities to put in this type of legislation. Now, there are some restrictions, like they can't ban payday loans, and there are some other things that they can't do, and they can't affect the rates. However, they can issue licenses, and they can refrain from issuing licenses, and they can decide who gets a license and who doesn't. Now, this is great for the large companies in Toronto who've already saturated the market. So, you know, your big guys like Money Mart, Cash for You, and Cash Money, they're already everywhere they want to be in for the most part in Toronto. So what does this do to the consumer? Well, it stops places like Payday from opening up in certain parts of the Toronto area to compete against them. And we like to think that we deliver the product much better. Prevents smaller guys like Direct Money, or Money Direct rather, to open up in those areas and compete. And in my experience, the consumer does better when there are more options for them and they have more choice. And if you take away those choices and you don't allow places to compete, you're basically handing over monopoly to some of the bigger guys who are gonna basically set the rules together, and they're gonna end up delivering the product the exact same way as the other guy as well, because they know that no other competition can come into that area. So there's no reason to appease the customer or do better for their clients. So that being said, I believe that this proposal of freezing and not allowing any other payday lenders to come in is a bad idea. We've seen some cities impose distance restrictions, not allowing payday lenders to be within 400 meters of each other. Of course, that would be grandfathered in, but again, not allowing newer companies to come in and compete in the high traffic, high density areas. That's just not fair, and it's very anti-competitive, and it's bad for the consumer. And it's also bad for people who own commercial properties, and it's bad for people who are looking for work. I mean, if you could imagine, with this freeze, there are going to be no more types of these businesses opening up in the city of Toronto, which means there aren't going to be any more jobs created by that. There aren't going to be any new employees hired in those areas. And the commercial property owners are going to have properties that are going to remain vacant for even longer. So my argument for that would, is to say that I think it's a bad idea, and I think those commercial property owners would agree. I think that the people looking for work in the city of Toronto would agree, and I think the consumer who uses the product is going to agree with me, because they're going to say they want more options. They want the opportunity to find a place that services them right and meets their needs the way they want it met. And we pride ourselves on delivering this product with the best possible technology, with the greatest ease to the customer. And I think that these types of laws are not good for anybody involved, including the city of Toronto. And I really think that they should consider not making these types of changes to this industry for all of those reasons I mentioned. Now, I was going to go through the rest of the derogatory comments that some of these counselors are going to make, but this video is on YouTube. I encourage you to go and look at this meeting, which is basically the Licensing Standards Committee, April 10th, 2018. It's readily available on YouTube. You can go and watch this video in its entirety if you so choose. But again, when looking at this video or this council meeting or any other council meeting, Hamilton recently had one, I want you to consider, if you would, the facts. And the facts are there. I mean, there's plenty of reports out there. I'm going to provide the links at the bottom of this video to several of those reports. And again, some of them are favorable for the payday loan industry, some are not. But one of the things you can't dispute in these reports are the numbers. The numbers have been tallied up. The math has been done. And in a state of Georgia where they banned payday loans, it was found that bankruptcies increased. They in fact skyrocketed. In one of those reports, they show the charts of where payday loans, the payday loan industry was outlawed, and what had happened to NSF rates and bankruptcies. Essentially, they skyrocketed. And so I guess that for me would allude to my narrative or my conspiracy theory that maybe the banks are the ones influencing these changes in government and these changes to these policies and the changes to the law surrounding payday loans, because the banks, prior to payday loans being introduced in Canada a little over 20 years ago, they probably were reaping the benefits of all the NSFs and the overdraft protections, and basically they were servicing that customer. They were just doing it in a different, way more expensive way. So, after 20 years, and probably over the last 10 years, they've probably started lobbying the government to make changes to payday loans, payday loan and microfinance financial lenders, because it is kind of digging into their profits. And I would argue that money moves most government, and that's unfortunate, but I think it's a reality. And I believe that there is some other force or power out there pushing this narrative through the media and through government. And the only individuals that I can see profiting from this movement, unfortunately, is the bank. And so again, I just ask, go do your research, go get the evidence. I'm going to provide you with some links. You're free to Google this, and there are a lot of reports for and a lot of reports against. But again, if you dig into the math doesn't lie. What happens to the consumer when this industry no longer exists is quite devastating. And again, I want you to remember some of the points that I made earlier. And I'm pretty sure a lot of consumers are going to stand up and say the same thing, that they are not uneducated, they are not poor, they may be underpaid, but they do have other options, and we are not their only choice. And understanding who the customer is very important, because if you can paint the narrative that they're poor, uneducated, and have no other choice, then yes, they're a victim. But when you realize that they are teachers, police officers, firefighters, government workers, construction workers, blue-collar guys and gals, and they're basically like everybody else. And pay today's consumer specifically is not someone who's on a fixed income. So they have to be employed, and they have to have a bank account. And for the most part, they're all educated, well-established individuals in the community who understand that a payday loan is just another financial tool that they have access to, and they consciously decide to use the service. So again, please go out there, do the research, check out the videos that to the links that I'm or sorry, not the videos, but the links that I'm going to provide. Check out the rest of this video, because it's quite disturbing what these counselors, some of them, are saying. And basically a lot of what they're saying doesn't even relate to this service at all. And speaking about some gentleman in India who had to sell his wife is really not what's happening here in Canada, at least. And one of the reasons things like that aren't happening here is because we have an established payday loans industry, microfinancial solutions available to our consumers. And consider that these misinformed narratives and these narratives that are coming from who knows where, consider that maybe they don't have the consumer's best interests at heart, and that they're actually working against them for the sake of their own profits. And some of the statements made in there that the banks are funding are heavily invested in these industries, and I can say with all honesty that the banks are not invested in our business at all. And then in fact they refuse to invest in businesses like us because they have come out and specifically said that they view us as competition. And in some cases we haven't been able to get leases in certain plazas because the bank is already there, and the bank has a non-compete clause in their lease that doesn't allow us to compete with them and to offer that consumer an alternative to the expensive rates that the banks are charging. So I would encourage you, go out, do your research. I encourage you to like this page and share it with anybody that you think might be having payday loan struggles. We're more than happy to educate the consumer on how to get out of the payday loan cycle if that's somewhere where they happen to find themselves. And we work to building mutually beneficial relationships with all of our customers, and I encourage you to ask me any questions you like. Please don't be derogatory or insulting, but if you have some facts that you want to share or you want to post up afterwards, please do so. I'll be happy to look into them. As I said, this industry has been my life's work. I've been involved in this industry for over 20 years. I can tell you that I'm not filthy rich, but I have put in a lot of hard work over the years, and I am dedicated to making this service the best it can be for the consumer. And I can tell you, if you look at our history, at Payday's history, you'll see that for years we've been challenging the status quo, and we've been lowering the rates ourselves without regulation, without legislation. And we've been pushing the envelope in this industry for quite some time. And I encourage you, do your research, go out and check out the information that's available out there. And I'm pretty sure most of you are watching this video have probably had to use a payday loan, and understand that you are an educated individual, and we weren't your last hope, and you weren't as desperate as everybody wants to point you out or make you out to be. So again, thank you for your time. Thank you for watching the video. If you could like and share the video, it'd be greatly appreciated. And again, please go get the facts, go do some research on your own, and make up your own minds. Don't allow people like these city councilors who have some other agenda or some other narrative that they want to push that isn't fact onto you. And if you happen to live in Toronto, I would suggest you contact your local councillor and tell them that you don't want these changes made, and tell them that you're not dissatisfied with the service that's being provided from these microfinancial services industry. And I got to tell you, if we don't exist and the rates go lower, small guys like ourselves definitely would not exist, because we just cannot afford to below the $15 per 100. And the report done in Ernst & Young in 2009 is evidence that towards that point. Because there is a cost of doing business. There is a cost of hiring employees. There's a cost to training them. There's a cost to renting the space out that services you. There's a cost to providing you a professional looking, inviting space to come into and do your financial transactions with us. And we respect you as a consumer, and that's why we go out of our way to make sure that we're providing you with a safe, friendly, inviting environment. And unfortunately, there's costs associated with that, and there's costs associated with borrowing money to lend you, the consumer. And so please take that all into consideration is all I would ask, and keep an open mind, because you're not going to know what you don't know. And once these industries are obliterated because of big banking wanting us out of the way, you're not going to know what you had until it's gone. I guess would be the best way to sum that up. But again, thank you for your time. Please like and distribute and share this video. It would be greatly appreciated.